You didn't know or care what this company ever did. You were just in it you were riding the hysteria. But of course, the more people ride the hysteria, the more hysteria there becomes, because as a speculator, I'm building up the price by wanting to buy these things alongside the people who may have wanted to because they actually believed in the technology that this company was doing. And you really had crazy things. You had many companies who had never made any profit, who publicly announced before the IPO, we do not foresee making a profit for the next 5 or 10 years. Whoa, you're buying a company that's a losing proposition and promises to be a losing proposition for years, and you're paying a wild amount of money. This is taking a big risk, right? But in this environment where people had made fortunes between Monday and Friday, lots of them, the way I just described it to you, the thing began to have a kind of momentum of its own. And again, as this got going, a whole new set of financial instruments had to be developed. For example, and I'm going to do this as simply as I know how, people did get nervous, so they began to demand something they hadn't demanded so much of before: insurance. They wanted to be able to protect themselves because they did notice, I certainly wasn't the only one, they did notice that you were buying and selling shares of a company, paying $500 for a share of something that had made no profit and promised no profit. It did dawn on you that you might lose your money. So you wanted something to be done to protect yourself. You wanted, in effect, a kind of insurance policy. So the financial markets, seeing that there would be a demand for that, went into business and produced it. Produced a variety of instruments, new ones, that were, in effect, insurance policies. And they wrote these policies, and these policies began to trade just like stocks. So Company A could write an insurance for you who bought these shares, but you could then sell them to somebody else who could sell them to somebody. They entered the very circus that they were trying to insure. They still were insurances. They allowed people to, this is the way it was called in the business, distribute risk. You didn't have to carry all the risk yourself. Huge markets developed. There had never been like this before. I'll give you another example, because every time the financial sector develops a new instrument, it tries to market it to a new set of people. So let me give you an example with these insurances. A company signs a contract to produce something and deliver it to, I'll pick a country, Japan, a year from now when the production is done. And it will be paid such and such many Japanese yen. Okay, smart man or woman in the executive suite says, wait a minute. We're taking all these expenses, hiring all these people, buying all this equipment. We're going to produce this thing. We're going to ship it a year from now, and we're going to get X yen. What happens if the yen crashes? So we're going to get a bunch of yen, but when we convert them back into dollars, it's nothing. We're going to be a losing proposition for us. What are we going to do? We don't want to lose the contract because it's a very profit. What we need is an insurance policy. We need a piece of paper that someone will sign with us saying that we have the right, we're the company, we have the right to buy yen, to sell yen at such and such a price on the day we deliver. Suppose I make I'm fearful that the yen is going to fall. So I sign a contract that says I can sell you, John Smith, 1 million yen. Let's say that's the price of the thing I'm going to deliver to Japan. So I'm going to get 1 million yen, and I'm afraid they're not going to be worth much. So I sign a contract that gives me the right to sell 1 million yen at a desirable rate for dollars to somebody, to some Japanese bank, or an American bank, or a Swiss bank, or Goldman Sachs, or AIG, whoever will sign the deal with me. Somebody who thinks that the yen is not going to move in a bad way, so great. Because I have to pay them to get this contract. I have to give them money, so they give me that obligation. But that obligation is good for me because it insures me against a change of the currency. When you make a contract like that to protect yourself, you can also, because that's what they did, all these things had to be invented by lawyers and accountants. They began to trade these things. In other words, you give me money so that I promise to loan you at a certain interest rate, say a year from now. Okay? So now you've given me money, you have my obligation. You can sell that to somebody else. If you think you don't need this anymore, you think the world has changed, you would like to recoup that money that you gave me. So you sell it to another person. So it becomes a market in the guarantees, in the insurance policies, if you like. The generic term for the kind of security that is really a promise to somebody to take care of a risk they have, that's called a derivative. Because when you buy that, you're not buying a share of a company that makes something. You're not loaning money to an entity that produces something. So it's not a bond, it's not a stock. You're actually investing in something that depends on something else in the world of finance. That's why it's called derivative. You're not directly investing in business, you're investing in something that in turn is dependent on how business is going. But you're not invested directly, so it's derivative, it's second order. So I have a different, I want to buy and sell these insurance contracts because I can make money since I know that I can buy something where there's no risk for me the way they think there is, and so I will become a speculator. Look, that's no different than going the earlier transition a million years ago when people stopped doing what's called barter. Right? Once upon a time, all markets were barter. So I made potatoes and I brought them to the market and I exchanged my potatoes for the shirts that you made. That's how you got potatoes to nurture yourself, and I got a shirt to keep warm. At a certain point, the awkwardness of having to come with my potatoes and run to you for my shirt and to you for my bread and to you for my shoes was, we had a development. And the development was to pick out one commodity that everybody would exchange for, and that would operate as the universal equivalent, something that could be changed into anything. So we all come with whatever we have, exchange it for that one thing, and then use that one thing to buy everything else, much more efficient. That thing is called money. That's why the earliest monies are always particular objects. Seashells, pieces of metal, certain kinds of grain. All of those things have served as money because the function of money was simply to smooth, to make more efficient the exchange process. But then, of course, there were people who began to see how the money moved up and down in relationship to and they entered and they started playing in the money market as speculators. So what an item of the finance industry, what gives it its birth does not govern what happens to it later. Right? Give you another example of this. The people in the best position to write guarantees of the sort I just said, we will take care of it if the interest rates go crazy, or we'll take care of it if somebody who owes somebody else money can't pay, defaults on that. We'll take care of it. Well, who's going to do this? If the person who promises to insure your risk is somebody you don't know real well, you're going to demand lots of money put aside as a reserve. Otherwise, why would you trust these people? Right? You'd say, okay, you're promising me, but what resources do you have to make good? It's as if you were approached by somebody on the street and have I got a great deal for you? I'll insure your car. $82, I'll take care of it for the year. Whoa, that's attractive. $82 to insure my car for the year. But then you look at the fellow, you notice it's not very well dressed. Just standing there on the corner, drooling. Right? And you say to yourself, it's a real good deal, but I suspect he may not have the wherewithal to cover an accident that may be happening to me and the other sucker he got into this arrangement. So if you're not very well known, if you don't look kosher, you're going to have to, and there are laws governing this too, you have to put up reserves so that you're a credible payer in the event that the insurance policy gets called. Okay, but then of course the profit of this begins to deteriorate. The amount you can charge people is offset by having to collect dead money that's not making you any money, that you've got to hold as a reserve. So the people who really can make a lot of money, are the people who can write these contracts, get the money paid by the people who want to protect against risk, but who don't have to hold any reserves. Well, who in the world could that be? It can only be the biggest, most famous, most prestigious banks and insurance companies in the world. Because everyone says, well, there's no risk there. So who played this game? AIG. That's why it's in the news. AIG was not required to put up any collateral or reserve at all. It was a AAA rated company, had been for years, was a cash cow, very profitable. It was the biggest insurance company in the world, had been, a merger of many little ones over the years. It built up. It had an incredible reputation, though it didn't keep any reserves. It didn't think it needed any. It always had some reserves anyway, just as a natural course of all the businesses. It does lots of different business, and much of it is a regular business generating cash flow to it. So they got away with so that's why it was so profitable. That's why they did it. They could write these policies, think they had very little risk. They knew the numbers of how many loans go bad, how many bonds default. There's very little risk here. We can get lots of fees, and we don't have to kill any money sitting in here because we're not required. With AAA, we're not required to hold it back. So they rode and they rode. They speculated on this market. That's all they did. But that's the problem. In a private enterprise finance system, the very instrument developed by one aspect of the finance industry to manage something becomes an object of others' speculation. And so now it begins to have a life of its own. It's like being a parent, right? It's your child. If you're very deluded, you think you can control this thing. I mean, it comes out of your body, it comes out of your life. And, you've all had this problem in more ways than you probably are conscious of how you have to break away from the thing your parents have in mind for you, because it's very hard for them very hard for parents to understand that the child is another person and therefore has their own direction, their own life. That's just the same thing here.